Is the era of predictable crypto cycles finally coming to an end? For years, the cryptocurrency market has followed a familiar pattern: massive bull runs fueled by hype, followed by devastating crashes that wipe out billions. But something is changing. Bitcoin just hit an all-time high of $73,000, and with another halving event in the books, investors are asking, will history repeat itself, or are we entering a new phase where the old rules no longer apply? Unlike past cycles, this time, institutions are heavily involved. Major financial firms are buying in, Bitcoin ETFs are bringing fresh liquidity, and governments are pushing new regulations that could stabilize or strangle the market. If the traditional boom and bust cycle is fading, what does that mean for investors? Will the days of explosive gains and gut-wrenching crashes be replaced by steady, long-term growth, or is an even bigger shakeup on the horizon? In this video, we'll break down what's really happening, the hidden forces driving these changes, and most importantly, how you can survive and thrive in this new crypto landscape. Because one thing is certain, the game is evolving, and if you're not adapting, you're already falling behind. For as long as Bitcoin has existed, its price has followed a pattern: massive surges followed by brutal crashes. This predictable cycle has been a cornerstone of crypto investing, creating millionaires in one phase and wiping them out in the next. But why does this happen? The crypto cycle typically moves through four key stages: accumulation, uptrend, euphoria, and capitulation. It starts when Bitcoin's price is low, early investors accumulate quietly, and then as momentum builds, prices begin to rise. This attracts media attention. Retail investors flood in, and eventually, the market reaches euphoria, when everyone believes prices will never drop. But then, reality hits. At the peak, early investors start cashing out. Panic sets in, and the market crashes, wiping out billions in a matter of months. Historically, this cycle has repeated roughly every 4 years, closely aligning with Bitcoin's halving events. Supply gets cut, demand spikes, and a new bull market begins. But now, with institutional investors and regulatory changes reshaping the landscape, many believe this predictable cycle is starting to break. So, does this mean we'll never see another massive Bitcoin crash? Or is an even bigger shift happening behind the scenes? Let's break it down. If there's one event that has historically fueled Bitcoin's biggest bull runs, it's the halving. Every 4 years, the Bitcoin network reduces the amount of new BTC entering circulation by half. This built-in mechanism makes Bitcoin scarcer over time, increasing its value. At least that's how it's played out in the past. Here's how it works. Bitcoin miners are rewarded with new BTC for verifying transactions. But every 4 years, that reward gets cut in half. In 2020, miners earned 6.25 BTC per block. In April 2024, that number dropped to 3.125 BTC. Fewer new Bitcoins mean less selling pressure from miners, and historically, this supply shock has triggered massive price surges. We've seen this pattern before. In 2012, Bitcoin was just $12 before the halving. 1 year later, it hit $1,000. In 2016, BTC was around $650, and by the end of 2017, it skyrocketed to $20,000. The 2020 halving was no different. Bitcoin started under $9,000 and peaked at nearly $69,000 in 2021. Now, with the 2024 halving complete, Bitcoin has already hit an all-time high of $73,000. But here's the big question: will the cycle repeat, or is this time different? With institutional investors and ETFs changing the game, the traditional halving impact might not be as predictable. So, what's actually driving the market now? Let's take a closer look. Something unusual is happening in the crypto market. Traditionally, Bitcoin's price surges months after a halving event. But in 2024, Bitcoin hit an all-time high of $73,000 even before the halving. So, what changed? One of the biggest drivers of this rally was the approval of Bitcoin spot ETFs in January 2024. For years, institutions stayed away from Bitcoin, but these ETFs allowed them to buy in without dealing with private keys or crypto exchanges. Almost overnight, billions of dollars poured into the market. The demand was so high that Bitcoin's supply on exchanges started drying up, creating a perfect storm for a price explosion. But that wasn't the only factor. Macroeconomic conditions also played a role. The U.S. Federal Reserve signaled potential interest rate cuts. which encouraged investors to move money into riskier assets like Bitcoin. Meanwhile, some of the world's biggest companies, including BlackRock and Fidelity, jumped into crypto, adding further legitimacy to the market. However, not everything is bullish. Some analysts warn that Bitcoin's rapid rise could lead to a sharp correction, and with increased regulation and institutional control, the market may not behave the way it used to. So, is this just another hype-fueled rally, or are we witnessing a fundamental shift in how Bitcoin moves? The answer may lie in who's buying and why. Let's dive into it.
Are you looking to secure your cryptocurrency investments? Meet Ledger, the ultimate solution for protecting your digital assets. Ledger offers top-tier hardware wallets designed to keep your crypto safe from online threats. With products like the Ledger Nano S Plus, Nano X, and the new Ledger Stacks, you can store your private keys offline, ensuring they are out of reach from hackers. Unlike hot wallets, which are connected to the internet and susceptible to hacks, Ledger hardware wallets provide cold storage, keeping your private keys offline. This makes them immune to online attacks. Paired with the Ledger Live app, managing your crypto has never been easier. Buy, exchange, and grow your assets all in one secure place. The app supports over 5,000 coins and tokens, making it versatile for any crypto enthusiast. Whether you're just starting with crypto or are a seasoned investor, Ledger has a device for you. The Ledger Nano S Plus is perfect for beginners, while the Nano X offers Bluetooth connectivity for on-the-go use. For the ultimate in security and customization, check out the Ledger Stacks with its advanced e-ink touchscreen. Ready to take control of your crypto security? Click the link in the description to get your Ledger hardware wallet today and join the millions of users who trust Ledger for their digital asset protection.
For years, Bitcoin was seen as a risky asset, something for tech enthusiasts and early adopters. But in 2024, that perception changed. Wall Street is now all in. The approval of Bitcoin spot ETFs was a game changer. Before this, big financial institutions hesitated to invest in crypto due to security risks, regulatory uncertainty, and technical barriers. But with ETFs, buying Bitcoin became as easy as buying stocks. The result, billions of dollars flooded into the market. Companies like BlackRock, Fidelity, and Vanguard are now major players, holding Bitcoin in portfolios worth hundreds of millions. Even traditional banks, once skeptical of crypto, are now offering Bitcoin investment products to their clients. This kind of institutional demand didn't exist in previous cycles, and it's a major reason why Bitcoin's price surged past $73,000 before the halving. But here's the real question. Does this mean Bitcoin is becoming more stable, or is it just another bubble? While institutional money brings credibility, it also changes the game. Big investors don't trade like retail investors. They move strategically, hedge their bets, and sometimes manipulate markets to their advantage. So, is this institutional adoption a sign of long-term growth, or are regular investors just setting themselves up to be outplayed by Wall Street? Let's look at how regulations are shaping this new era. Regulation has always been a wild card in crypto. In the past, uncertainty over government crackdowns fueled massive crashes. But in 2024, something shifted. Regulation is no longer just a threat. It's shaping the future of the industry. The approval of Bitcoin spot ETFs in the US wasn't just a financial milestone. It was a regulatory signal. It showed that governments are starting to accept Bitcoin as a legitimate asset. Even traditionally skeptical countries, like the US and the UK, are laying out clearer rules for crypto markets. Meanwhile, pro-crypto politicians are gaining influence, and some even argue that crypto regulation could become a key issue in future elections. However, not all regulations are positive for investors. Governments are pushing for more control over crypto transactions, stricter tax reporting, and even potential restrictions on self-custody wallets. The European Union has already introduced the Markets in Crypto Assets (MiCA) regulation, which tightens oversight on exchanges and stablecoins. So, what does this mean for the future? On one hand, regulation could bring stability, attract institutional investors, and prevent scams. On the other, it could strip away some of crypto's original appeal, decentralization, and financial freedom. The question now is, Will these new rules help Bitcoin grow, or will they turn it into just another heavily controlled asset? And more importantly, how can investors adapt? Let's explore what's next. For over a decade, Bitcoin has followed a predictable boom and bust cycle driven by halvings, hype, and market speculation. But with institutional investors and tighter regulations now in play, many are wondering, are the days of wild crypto cycles over? Historically, Bitcoin's price has surged after every halving, but past cycles were fueled by retail investors, speculation, and hype. This time, institutions are leading the charge. Unlike individual traders, they buy and hold for the long term, which could smooth out Bitcoin's extreme price swings. In other words, the days of 90% crashes could be fading. At the same time, governments are stepping in with regulations that could prevent reckless market manipulation. While this might make crypto safer, it also means the explosive, unpredictable growth of past cycles might not repeat in the same way. But here's the twist. Crypto is still a young and volatile market. If history tells us anything, it's that cycles never truly disappear. They just evolve. New factors like global economic shifts or major technological breakthroughs could still create massive price swings. So, is this the end of traditional crypto cycles? Maybe. But one thing is certain. The market is changing, and only those who adapt will thrive. The key now is knowing how to navigate this new landscape, and that's exactly what we'll cover next. With the crypto market evolving, the old playbook may no longer work. In the past, investors could simply buy Bitcoin before the halving, ride the hype, and cash out at the peak. But with institutional players, regulations, and shifting market dynamics, survival now requires a smarter approach. First, long-term thinking is key. Institutions aren't day trading Bitcoin, they're holding for years. Retail investors who adopt a similar mindset, using strategies like dollar cost averaging, or DCA, can avoid the stress of market swings while building long-term gains. Second, don't rely on old patterns. Crypto cycles may not follow the same explosive booms and crashes of the past. Instead of betting on another 1,000% surge, focus on solid projects, real adoption, and macroeconomic trends. Third, diversification matters. While Bitcoin remains the strongest asset, other sectors like DeFi, AI-driven crypto projects, and blockchain infrastructure are emerging as potential winners. Being too focused on just one coin could be risky. And finally, stay informed. With governments introducing new regulations and institutions shifting market control, understanding the bigger picture is crucial. Crypto is no longer a Wild West. It's a battlefield of strategy. The old rules are fading, and a new era is beginning. The question is, are you ready to adapt, or will you be left behind?
If you haven't already done so, visit our website. You will find the link in the description.